I am not in Nice. I am in Paris for another 2, 3 weeks.
Nice.
Um, okay, so we're back to pretty much where we were before the little bit of movement and scary situation, if we can really call that scary. But yeah, we've had 1 or 2 weeks, early Junes, where things were moving a little bit more than expected. Definitely, I think it took a few of us off guard straight after the NFP. And then I think there was a lot of anticipation built up around that press conference from Wash this week. And that actually showed up. We'll see that in a second when we'll see the realized volatility charts for the week and for the week overall. But then once that stuff was digested and it was fairly apparent that nothing new really came out of that stuff, right? Like Fed is likely to hike rates. I think now the market is pretty used to that idea. And given that information, we still close at VIX 16, right? So once again, um, it's going to be a bit of the tune, I guess, for the next few weeks, especially as we get into one probably or the lazy summer. Um, People will try to convince with very scary headlines that the market is not anticipating a rate cut. If a rate cut happens, the markets are going to react really badly and going to tank terribly. And if inflation goes up, the S&P is going to be at like, I don't know, 5,000 maybe. I'm not saying that stuff cannot happen, but again, the market game is a game of incomplete information. But then in some situation, you have some sort of complete information. Sorry, incomplete information. And right now, it's not that we have complete information, but we know about all of these things, right? Right now, it's June 21st. We know that things can get complicated on the inflation front, on the rate fronts in the next 3, 4 months. The market is aware of that. So it's priced in, right? Whatever comes in, it's gonna have to be really out of expectations. You will need to see inflation in the range of 5.5, 6% for the market to really start worrying about that stuff. Or Wash being really aggressive in the way it talks about hiking rates, right? And really aggressive is going to be the trajectory for next year, for instance. But otherwise, all of that stuff now, it's pre-digested. The market knows about that. And June 21st, given that information that came in, VIX is at 16, VVIX is at 90. Those are not numbers that tells you the market is scared of what the next few months have in store for us. Once again, it doesn't mean over the next few months things cannot derail, cannot go back to VIX 30 for a few weeks. But with the information we have today, and again, that are going to be more or less front page news over the next 6 weeks because we need to keep the agenda busy, it wasn't enough to really get people hyperventilating, right? We have 90 on this front, which is pretty much long-term average, right? We know that 90 is the point where VVIX is, in between those two states. It can get really low as like 60, as we see on that chart. More likely, you have two modes. You have one mode where things are quite stressful, and the average median for VVIX is about 100. Otherwise, it's somewhere around 90, a little bit below 90. It depends on the periods. And essentially, given that Wash press conference is behind us, given that the Iran situation looks to be diffused now, taking its time but getting diffused, VVIX back at 90 is confirming, at least from my perspective, that the market is switching gears, that we're changing regime, that we're not going to keep buying VVIX and VIX calls at about 100 and 100 and more just because something may be happening, right? So if you compare again a year ago, VVIX would never go down below 100. It would go to 90, 95, and then quickly go back to 100. Over the course of 3 weeks, we've seen it go down as low as I think 82, 83. I've seen it at some point. back to 103, 7, I think at some point I saw when Trump was getting a little bit feisty last week, feisty last week, and then back to 90. So that's another characteristic of that new regime. For months last year, the range of movements in VVIX were much tinier. You would move from 95 to 105, eventually go to 110. Now you can the range is already much bigger. Like, yeah, people are going to get more comfortable, and then potentially they hear stuff that are going to scare them, and then it's going to go back to 100, 105. So how do you get comfortable in this new phase? Well, you need to remember that, yeah, like finding 5, 10 points of VVIX in a couple of sessions is, I'm not going to say normal. Obviously, you always want to check what's going on, but it's much more likely to happen than when we were already back at 100 and find less people to get scared about what can potentially happen. And basically, that variance is a little bit higher. Now, again, getting into the summer, I suspect that variance in VVIX is also going to go down, but it's going to be interesting to see end of July, you have the next FOMC, and then you have an NFP, and then very quickly you get into Jackson Hole. So all this kind of stuff that big hands are looking into to decide whether they hedge, whether they sell stocks or whatever. At the end of the day, that's really what you react to, because this is what your customers, people that are buying options, right? Those are your customers. This is the kind of stuff that they look into. So you need to have an idea of what is likely to make them react and overpay for options. So I suspect that variance even in VVIX is going to go down over the next 4 weeks. You don't sound rocket science. It's month of July. You have 4th of July. Usually the first 2 weeks of July, it's really dead. And then that can continue throughout the entire month of July. But then, yeah, FOMC, NFP, Jackson Hole, September CPI or something like that, and very quickly after that you have another FOMC. That period of 2 months from end of July to mid-September, that's something you probably want to have in your calendar. Jackson Hole is it's an interesting one because it's going to be the first one for Wash. It's something that we don't. I mean, at least when you're on the market, when you've been on the market long enough, you know that the market tends to react to that one, especially for newcomers on the FOMC, right? They're going to listen very carefully to what they have to say. I'm not saying for sure things are going to move, but I mean, I didn't hide it the last few weeks. I was probably a little bit less focused on FOMC month of June than I am in Jackson Hole, and I don't want to talk for the entire marketplace, but I'm pretty sure this is also where the marketplace is at the moment. Um, that's enough VVIX, VIX, and macro stuff. Yeah, but just look at it one last time. We're here, right? And we know about inflation. We know about wash potentially hiking rates, and we're here. Uh, if you want to go back here, you need to come up with some seriously new information. Otherwise it's priced in. What do we do and what do we see exactly from the data at the moment? So this is the last 2 weeks where we had a little bit of stress at some point about, yeah, that was Tuesday, almost 2 weeks ago now. Continuation of NFP. We've seen implied vol getting above 20. We had those wild swings intraday. It was a little bit hard to attribute them to exactly something, but overall, vol was high, and then the regime was clearly go harvest some BRP because you're more likely going to be fine than not. We have that tiny yellow dot right now that says post-stress. So it's interesting because even though we were not classifying this as stress, the way the market is stabilizing from a data perspective right now looks like it's very similar to one of those dots. The characteristic of those dots is usually you have negative VRP, and even though we don't have negative VRP here, we're really close, right? So it's those regimes are really characterized by the fact that implied was high for quite a while, right? Like the clustering model behind that is aware of this, that Z-score in implied volatility was high, Z-score in VRP was high for a bit. Vol of vol was probably a little bit elevated, and then all of a sudden, all that stuff collapsed. The demand for option goes down quite significantly, and you get a VRP number that's much smaller. You got implied that much smaller than what it used, and you have that disconnect between well, realized volatility is still high compared to the what it could be over the next few weeks. It's still high right now the way you measure it, but implied vol is already anticipating that things are probably going to be quiet over the next few weeks. So the market has already dumped all of the insurance contract that they bought over the last few weeks. And then you have that disconnect between the two values and the clustering models basically classifying that as a post-stress regime, right? We used to buy options. Now clearly we don't buy them anymore. So post-stress. What do you do in a post-stress scenario? It's always a little bit, it's definitely not the kind of stuff I prefer because you don't want to be selling VRP here. 1.5, it's clearly not great, right? You just need one of those weird adversarial move. And we're really in that period where this kind of stuff happens, right? Like I was saying, I'm not sure anyone can really attribute the move that we had week of June 10th to anything. Maybe a little bit of Iran, maybe a little bit of portfolio dressing, maybe a little bit of anticipation of wash. It's hard to really pinpoint to something. And it's the same probably for the next 2 weeks until you get into a new semester, a new quarter, and maybe portfolio dressing has a little bit less impact. I insist on that. There's only a few moments in the year where I think this stuff has an impact, and this is one of them, especially when you have the Qs up 20% already in the year, and when you have SPY already up 10% in the year. Remember that the bulk of the market moves because big fund managers have to justify fees, and fees is tied to an index, and usually SPY and the Qs are very good index. And if you can't justify that you're beating the index, usually it doesn't look good. So all of that has a big impact on how portfolio are being rolled and constructed. And ultimately, because I'm not the kind of guy that says the tail wags the dog, I think it's definitely the other way around. Ultimately, yeah, you can get into those situations where, okay, well, there's 2 more weeks now, at least one more week. I don't think that's going to be because of gamma, but potentially if someone has a ton of Nvidia to sell, a ton of SpaceX to sell, we can see realized volatility stay at around 15. That's pretty much what we've seen over the last two weeks. That model is always a little bit lagging. It's basically saying over the next 30 days, it's likely we see 20. I'm not so sure because it's not aware that 4th of July, all that stuff. But yeah, over the next week, 15, 16, it's not unlikely. If you play here, once again, you're most likely going to have trouble. The last 2 weeks, I think, must have been quite painful. If you were selling zero DTs, Wednesday was probably a bit painful. Same for Thursday when you have one of those big reversals. Those are characteristic of high realized volatility. Things are moving around quite a lot. Um, and you're basically paying gamma, right? Like you're being hammered by gamma, even if your strikes are far away, the movement are so wide and there's so little time for you to realize anything that those positions are going to be painful. What's more uncommon, especially since Liberation Day, is to see that region of the curve where you have only 1 point of VRP. Once again, we talked about that in a few seconds. Characteristic of post-stress regime. What do you do? Personally, I would wait. You never know. You can get something. You can get a headline that brings VIX back to 18, 18 and a half, and then I would definitely jump back in. That gives you 4 points. It's not amazing, but it's fine. 18, 19 would be fantastic. And then if you wait and you never see 18, well, that gives you more information because we can talk about this next week. But if we don't see 18 in the VIX, you'll see that chart in realized volatility to literally collapse. the VRP to now be much more pronounced and meaningful, and most likely we'll get out of that post-stress regime and be either in calm or positive VRP again, where you have 3, 4, 5, 6 points, 7 points ideally, always there to be harvested. Um, but yeah, we'll see that in a second, a little bit better than that. But again, if you're expecting something crazy to happen over the next few weeks, it's possible that, yeah, you have a big move down for whatever reason. Maybe because there's another article on AI, maybe because Trump and Iran, there's something else happening, I don't know. But this is a pretty steep contango at the moment. You go from 18 and a half at 3 months to 16. We've seen steeper contango than that, but I mean 13 and 9 days, like it's not a market that's pretty scared of what's in front of it. And this is just the resultant of 2 weeks of high realized volatility, realized cluster. But I'll be very curious to see if we don't start to see some quite low numbers here this week, and maybe one big day, maybe around Thursday, Tuesday, Thursday, maybe something like that. But I would suspect that that stuff's gonna start to collapse. Anyway, here the big stuff is here. Don't play in zero DTs at the moment. I'm not sure I mean, it's not even I'm not sure. You're not really well compensated for the risk at the moment. If anything, you want to buy maybe a little bit of gamma more than ever. Um, what to trade and the stuff that are a little bit better. So this one we'll speak about it in a second because it's a very interesting one. But otherwise, the focus is on tech. The vol on tech was extremely expensive over the last few weeks. I think mostly because of SpaceX. It's always high anyway because you have the AI premium risk, right? Like overall, people are buying options in technology stocks because it might be disrupted by AI or because well, the valuation is a little bit scary, right? So it's actually a very interesting moment in tech where whichever angle you look at it, investors sees risk anywhere, right? Everywhere. If you're a semi, it's risky because valuations are getting crazy. If you're SaaS, it's risky because AI is coming after you. Which one is right? I don't know, but overall, you see a wide demand for volatility and options in technology since the beginning of the year. And I think it's accentuated by the fact that overall that stuff is still up 20%, right? When you're up 20%, but the risk perception is higher than ever. The chatter, the commentary around AI, the bubble, and all that stuff is at the moment at all-time high, and I think it can get even higher than that because OpenAI, Anthropic, all of these guys haven't even eaten the public market yet. But when they will be there, the chatter will be just constant. Obviously, people are going to buy options to protect the level of performance that we have. So yeah, it shouldn't come as a surprise to see once again semis with pretty high chance to see implied that you sell today exceed realized volatility. Semi. It's not exactly technology, but kind of biotech technology. Not really surprising. Semi again. At the end of the day, you really have two or three stocks that are driving the Korean market at the moment. Technology, and then, well, this one is an interesting one because Korea is part of emerging markets quite a bit. So obviously, that's going to drive implied vol in EEM, and then you go up to the Qs. So, if we go back to this, if you want to trade VRP right now, Um, obviously SPY doesn't give you amazing odds. I think it's okay to swap some of the sleepiness of SPY compared to others, right? Like SPY realized vol is 15, the realized vol in the Qs is 25. It's definitely not the same feel when you put a trade in one or the other, especially because the Qs is a much more expensive contract than SPY. So it's more expensive, it moves more, but at the moment, your odds of being able to get anything out of anything that's technology is high. So you should probably consider it one way or another. The interesting bit though is at the moment it's also similar. The situation is similar than what I was describing in SPY. You don't see crazy amount of VRP in the queues right now, even though the probabilities are higher than SPY. So yeah, just get to places where you're probably gonna have better better odds, whether you consider SMH. If you're really crazy, you can consider Soxol. But otherwise, yeah, like VRP is quite thin, can even be quite negative in the case of ETH. And ETH is also an interesting one. It's basically us looking at, let's actually pull it up. It's us looking at how do we get to these probabilities, right? Because sometimes we do have it's the other one. Sometimes we do have the questions, and I think it's nice to be able to answer it. We actually let's go back to this chart. We take a bunch of metrics, features regarding historical realized volatility, the different term structure, vol of vol, same the term structure. We process that into a machine learning model, and ultimately we are in a position to say, well, even if VRP is down right now, typically it's negative, it's still a good time to potentially sell option in one of those names, because we do expect IV to go down, but we also do expect RV to go down quite significantly. So your VRP might look negative at the moment, but the question is more, does the market anticipate something and therefore is not really willing to keep buying expensive options, and therefore in anticipation, it's likely that realized volatility will be much lower, right? Or is the market completely wrong? And you can make those inference and you can answer those questions once again by just comparing what just happened, create features, nice configured features around that, and then ultimately coming up with some predictions. At the end of the day, it's still a probability, right? It doesn't mean it's going to happen for sure. But so far this year, it served us pretty well. We're not going to be moving away from this. I think people should be trading with anticipation of what's going to happen next rather than describing the moment or what just happened. And this is a great example. That -12 here is probably overstating what is likely to happen in the future. Again, the market doesn't just dump options for the sake of it. When it does, it's because they're pretty convinced that the worst of the risk is probably behind them, and the next 30 days, right? We're not talking 6 months in the future, but the next 30 days are probably going to be a little bit more quiet than what people anticipate. If we look into XLK, it's a very similar story. Yes, quite, almost negative and stuff like this. But was still pretty confident that overall realized vol is going to come down. I I I insist on, and I go back to what I say, right? Like obviously you can come and put the trade on Monday, but sometimes it's okay to wait Tuesday, because you don't know Tuesday market reacts, or you can see that Monday things are a little bit shaky and VIX start to go up and people get a little bit scared for whatever article that just came out on the Wall Street Journal or whatever someone said. And all of a sudden, something that was negative here with already great odds becomes positive, and now it's really a fantastic trade. So, sure, like if you don't have the time, you can probably put the trade first thing on Monday morning. If you can wait a little bit to see what's the mood, what are people reading about, talking about on social, That's probably what I would do. Um, that's it. If you guys have questions, I'm happy to answer. Anyone else join?
Alex, I've been looking at just given where we are in the market, looking at doing maybe some long volatility trades on single stocks. I know we don't talk about that a lot here. I guess just as far as the tool goes, yeah. So what I've kind of been doing is looking for negative VRP names in this column here that have a strong kind of RV up signal. Is that kind of how you kind of fashion the tool, or kind of what are your thoughts on that?
No, you could go and so same. So here this is gonna give you the probability to see RV going up. So that's probably a good start.
Okay.
But this gives you the probability to see implied you sell today exceed subsequent realized volatility, which is ultimately the real question you want to be able to answer, whether you are short or long options. And here, well, you have plenty of solid names in there. This one probably is really nice. That that pops up immediately, right? Like I think having a read on the direction in realized volatility is useful, but it can become misleading.
Mm,
Having a read on how cheap implied is in anticipation of what the market is likely to do over the next few weeks is probably a better read. And I would do it, I mean, again, it depends what you're trying to do, but um, going 9 days sometimes, basically identifying cheap gamma can be useful, especially considering that we're getting close to um, earning sessions, right? The earning season is really close. So actually, the earning is a big it's a big feature in our models, right? Like I don't know what comes up as to the reason why we predict VRP right now. No, earnings are not going up. We're mostly predicting long because yeah, implied vol is really low compared to what it used to be, and same for VRP. Oh, and the slope. We're saying that the term structure is way too steep, and at some point it should probably move back a little bit to a better shape. But sometimes when you look into those, you'll find that earnings can be a reason why we make such prediction. And then this becomes quite handy because you know that like yeah, with earnings not so far away, people are likely to I mean we know overall it's a well-known fact that overall you may want to be long vol ahead of earnings. So when you have all of these things that align themselves, like right crazy VRP down, the probability is really high, like some of these names, and then you know that earnings are around the corner. That's probably something you want to consider.
okay, yeah, no, that's helpful. So you would take the VRP column as kind of your lodestar, and then use the RV up down signal as kind of confirmation.
Pretty much. Like I spend most of my time with that number. That's really what I look at. I'm more looking for trades that are going to be on the short side for obvious reasons.
Right.
And then yeah, those numbers aren't going to invalidate my thesis, but they are going to drive more how I structure the trade and give me a sense of where my risk is and what my risk management should be. So for instance, RV here, RV up is not going to tell me this number knows that RV is likely to go up, right? This number has access to the same features, right? All those models have access to the same features, but they just don't predict the same thing. So that
Mm.
number is aware that like, yeah, like realized volatility might be a bit cheap and things might go up. Um, so that's definitely not going to invalidate my thesis, but that's going to get me to really avoid anything that's too close to the expiration game, right? So in particular here anyway, the prediction we make is at about 30 days, right? We're basically saying implied vol you sell in the region of 30 days is going to exceed realized volatility over the next 30 days. So by definition, you should already try to structure a trade at around 30 DT. But sometimes the way contracts work, right? Like you can get halfway and then you might be asking, okay, well, there is a 25 DT or there is a 32 DT, right? Or there's a 28 and then 35. Do I take the 35 or the 28? In a situation like this, I will definitely take the 35. I might even go to 42 and give myself even more time because I don't really want to have extra gamma, right? We usually keep trades for 2 weeks. So if you put 28 and then at the end of the trade, you start to be in those region like 16, 17 DTs where something can happen and then things move a lot and your trade is a bit, can be a little bit harder to manage. That's the cost of gamma basically. So I might even go to 42 DTs here, especially when I know that, okay, well, IV is likely to go down. Those 40 DTs have higher Vega baked into them than the 28 DT. So basically, this tells me gamma might come slap me in the face, so I don't really want to get close. And this tells me implied is likely to go down anyway. So yeah, 42 would be quite nice in a situation like this. And then vol of vol tells me is you put a trade on, um, you're short vol, right? Obviously, but if you see 3, 4 points of vol going against you very quickly, should you panic or not? Um, and basically, in the current market situation, because things are much more quiet now, like that basically tells you like first of all, it's unlikely to happen. Like vol is likely to go down. So you shouldn't really be that Vega going against you is probably unlikely. Or if it goes against you, it's probably not going to be by a lot because vol is low. Um, but yeah, like we would be looking at that number in March. uh, it basically tells you like, yeah, even if you go trade VRP number, be aware that vol is moving a lot and you can wake up with 6, 7 points of vol against you, and you want to size accordingly, right? That's really all of these things help me to think about how am I going to structure the trade and how I'm going to think about risk management. But they are unlikely to have me decide whether I'm going to put a position on. The only thing that will have me decide, or not me, but I sometimes say to people, especially if you're new to vol trading, um, you might not be willing to trade anything where RV is above 50 because things are moving much more. It's much more prone to jump, right? Jump risk is a big problem when you try to sell options because you can't hedge that risk. Whether you delta hedge or not, you wake up, market is down in the morning 6, 7%. There's not a whole lot you can do about it. And that is obviously much likely to happen when you start to get in those high RV numbers than when you're on the lower side of things. So when you're new to it, you don't exactly, or sometimes not even being new to it. If you don't want to have to really manage that risk, right? You're being paid for that. If you don't want to have to think about this because you have job, you have the kids, you have a lot of situations, yeah, you might want to like exclude places where RV is above 50, but that's about it. Then the stuff that really drives decision making is right here.
Okay, no, thanks. That's helpful. Yeah, no, I've just been trying to experiment with, again, I'm new to vol trading, and I was just trying to, again, this is, almost as a way to either balance the short part of the book, which the majority of my book obviously is short vol, and then also just given where we are, just the quietness in the market, maybe looking to put on some long vol trades.
That makes total sense. And in fact, the way I structure stuff, I try to get. So obviously, you guys see me talk in the Discord a lot about always having puts in the back months and have that as like your hedge to make sure you don't blow up. I think this is the place where anyone should start. You sell the first few front months and then a few weeks, months, and then you go hedge yourself with stuff in the back no matter what. But then yeah, like if you try to get a little bit more precise, I like to sell vol in places where there is limited idiosyncratic stuff, idiosyncratic risk, so more likely ETFs. But then
Mhm.
if I have to go long vol, I will probably look for places where, yeah, you can have a massive dislocation happening because of earnings, because of news, because of anything like this. And if on top of that you're able to have a slight quantitative view on things and say, well, that stuff is actually quite cheap and something's likely to happen there, then yeah, it's another great hedge. I'm not using long vol to really make money over things, but it's a great way to, yeah, balance the portfolio. Like I didn't see that one, but I'm definitely going to look into AI Monday morning and buy a few straddles in there because again, earnings are not too far. There's always a lot of chatter around AI, not the company itself, but just AI, the sector, tech sector overall. The VRP is crazy massacre at the moment. Uh, yeah, let's look into this.
That VRP value there, that 21.3, that's not close to close, right? Is that your 5 minute? Is that's a
Yeah.
different model? Okay.
So RV, the way I measure RV is the way you would see RV measured in most institutional places, right? Like close to close is still used in a lot of places in finance, actually. Let's start there, right? But in any normal quantitative desk that's trying to understand realized volatility as a process and not as I'm going to say a risk measure, but then all risk managers on the planet are going to jump on me because they probably use also high frequency RV. Um, but in anything sell side, when you try to sell something to investors, people still use close to close. In fact, CBOE released a product variance the other, I think about one or 2 years ago, that still use that uses close to close. So close to close is still used. But if you want to use realized volatility as a statistical process and you want to be precise, you need to use high frequency data. And yeah, 5 minutes, 15 minutes, depends again what you're trying to do. You can even get much lower than that in some use cases. Like for some very liquid ticker, I go much lower than 5 minutes for some very specific use case. But that's what gives you a very high degree in precision in measuring the process you're trying to get a read on. And at 30 days, yeah, 5 minutes, 5, 10 minutes, however you want to look at it, you're probably going to be much more precise than close to close.
Yeah, I guess maybe in that vein, like when I look at AI and VRP Central, I know you have the model free IV and the variable swap. It seems
Yeah,
to be it's. I guess how should I kind of, because I mean they're not the same numbers. Um, so that you go to the VRP term structure tab.
yeah, VRP term structure. Um, so that's an interesting one. Maybe here there might be a problem in my data set. So I'll look into this
Okay.
because yeah, clearly something may be wrong here.
Yeah, I
Yeah.
was kind of going through these this weekend, just kind of looking for potential long ball candidates, and I saw this one of them that I looked at as well. I was trying to
Okay,
stay
so I
away
know
from.
what's going on. No, I
Okay.
know what's going on. And that's also why I don't spend too much time on the VRP page here. So
Hmm,
basically, let me tell you what's going on. Here, first day was well, that's the last day of a short week.
right.
We take data at 3:45 p.m. on the first day. That was a pretty slow first day anyway. What you tend to see at 3:45 p.m., I mean, already the last half an hour of any session, but even more when you have a short week, um, market makers, they widen their quotes quite significantly. And I
Mm,
compute variance swap with the bids. So basically, it's very likely that at 3:45 p.m. on Thursday, the bid of market makers was reflecting 40, which therefore drives like a VRP that can look really negative. But then
mm,
when you keep looking and you get into the close and you compare to this, well, those are probably the more the actual numbers. But you see it here, right? Like so basically when you look at VRP Central, this gives you the bid and ask band. So basically, again, variance swap, you compute implied volatility using only the bid or the ask of option that are out of the money. And if you look at at your bid and then your ask here, you can see that these guys are, quoting really, really wide.
mm,
Because at the close, actually, the number is not 40 as we see on the other side, but it's 60. But then on the ask side, it's probably somewhere around 90. So it's likely that at 345, the bid that we use anywhere on the platform, right? We always use the bid. The reason why we always use the bid is because, again, I'm more on the sell side overall, so I want to know if I was selling at the bid, not even mid, because mid you might not be sure to get it, but if I was selling at the bid, what are my odds that implied vol is going to exceed realize? So on the long side, that puts you a bit as at a disadvantage because that bid number, yeah, sometimes can be a little bit can be wrong and be a little bit crazy and things on the long side. What you're doing here, you have to do your due diligence a lot more than on the short side. But that's exactly what you're seeing here. Like I'm pretty sure that if I was to replay that and show it what it was back at that moment, the quote were even wider than what they were close to the close.
and this will update what, maybe 30 minutes after the open on Monday, the VRP Central.
Yeah, no. So VRP Central update lives. So the minute will be up
Okay.
on it's one of the stuff that we have live. So the
I,
minute will be live on Monday. That stuff's gonna be updated. But in comparison, if you look at something that's really tight, right? Like here you don't even see your bid ask because stuff
pennies.
are really tight. If you go to Nvidia, you see a little bit, but it's mostly because it was Thursday and I think people were dying to go in holidays. But yeah, in those other names where there's less volume, there's less people, yeah, like usually last half an hour anyway, you'll see your bid ask widening because people don't want to get adversely selected. It's often at that moment in the day that people with information are going to show up. So you tend to widen your quotes a little bit. Um, but yeah, then it's live, so you can get those numbers and then compare it to them. I'm working to find a way to get that to give that a little bit more of a real-time feel. Hopefully over the next few weeks, months, so that like yeah, you can see based on the day and what already happened throughout that day, you can see that number and all of these numbers overall being updated and especially on the probability side.
Great. Okay. Thank you.
Yeah, you're welcome. You're welcome. Well, I guess I speak to you in the Discord.
Absolutely. Have a good weekend or enjoy
Thank
what's
you.
rest of
You
the
too.
weekend. Thanks. Bye.
Cheers. Bye.